Good evening, everyone. Today we delve into a topic that stands at the crossroads of economics and geopolitics. The evolving dynamics between the United States and China. What most people see when they look at U.S. China trade tensions is a surface level conflict, tariffs, trade deficits, supply chains moving, companies caught in the crossfire. But those are just the symptoms. The reality runs much deeper. What we're witnessing is a manifestation of large, slow-moving structural forces that have been building for decades. To understand what's really happening, you have to look beneath the headlines and study the long-term mechanics of the global system, how capital, labor, productivity, and debt interact across borders. At its core, the U.S. and China represent two very different models of economic growth. One is consumption-led, heavily financialized and driven by demand. The other is investment-led, production-oriented and driven by supply. For a long time, this created a kind of symbiotic relationship. The U.S. consumed more than it produced, and China produced more than it consumed. China accumulated U.S. dollars through trade surpluses and recycled them into U.S. assets, mostly treasuries, which helped keep U.S. interest rates low and fueled further borrowing and consumption. This loop created the illusion of stability, but over time, imbalances grew. The U.S. ran persistent current account and fiscal deficits. Its debt levels increased faster than its income. China, on the other hand, became dependent on exports and investment to sustain growth, leading to overcapacity and misallocated capital. Both models became fragile in their own ways. The global financial crisis of 2008 was a wake-up call, but it didn't result in meaningful structural adjustment, just more monetary easing and larger debts. What we're now seeing is the delayed consequence of those imbalances. When debt grows faster than income for too long, it becomes unsustainable. When a country relies too heavily on another for financing, strategic vulnerability sets in. The U.S. dependence on Chinese production and Chinese dependence on U.S. consumption created mutual exposure. As each country tries to rebalance in its own way, conflict is inevitable. That's what trade tensions really are, not just disagreements over tariffs, but friction arising from a structural shift in the global order. China has long signaled its intent to move up the value chain and reduce reliance on foreign demand. It wants to foster domestic consumption, develop indigenous innovation, and internationalize its currency. The U.S., meanwhile, is realizing that hollowing out its manufacturing base in favor of short-term efficiency has created long-term strategic risks. Both countries are trying to pivot, and when two giants shift at the same time, tremors are felt globally. This transition is compounded by another structural factor, the changing nature of the world order. The post-1WI system, dominated by the U.S., created institutions and rules that reflected American values and interests. That system is being challenged not just by China's rise, but by the internal weaknesses of the existing order, rising inequality, political polarization, and declining productivity growth in the West. When a leading power shows signs of relative decline and a rising power gains momentum, the probability of conflict increases. History shows this repeatedly. The trade tensions are a front in a broader strategic competition. Technology, capital market, supply chain control, reserve currency status. These are all battlegrounds now. Tariffs and sanctions are just tactical tools. The deeper reality is that the old model of globalization, where capital flowed freely, production sought efficiency, and nations accepted interdependence, is being reevaluated. Sovereignty, security, and resilience are replacing efficiency as guiding principles. And that marks a profound shift in the global economic framework. The path forward depends on how both sides manage this. transition. It requires rethinking models that no longer work. The U.S. must address its internal imbalances, fiscal discipline, investment in real productivity, and rebuilding industrial strength. China must face its debt challenges, slow down unproductive investment, and unlock household consumption. These are not easy tasks. They involve short-term pain for long-term gain, and political systems don't always reward that kind of discipline. But ignoring the structural roots of the problem leads to greater risks. When economic tensions are treated as isolated disputes rather than symptoms of a deeper disease, the responses become reactive rather than strategic. That's when errors occur. The challenge is to step back, understand the mechanics of the system, and design policies that address causes, not just effects. In the end, the U.S. China trade conflict is not about who wins or loses a negotiation table. It's about two systems undergoing transformation, colliding as they adjust. The imbalances are not just between countries. They are embedded in the global economic structure itself. Addressing them requires clarity, patience, and a long-term view, qualities that are ensure supply, but absolutely essential if this transition is to be managed without crisis. Most people think of tariffs as simple tools to protect domestic industries or address trade imbalances. But in reality, tariffs are far more than that. They are levers in a much larger game, used not just to adjust prices or restrict imports, but to shift the strategic balance between nations. When deployed in isolation, they can create temporary economic adjustments, but when used persistently, and especially when backed by larger structural forces, they become signals of a changing world order. Historically, tariffs have emerged not just in response to economic grievances, but at inflection points in the global balance of power. In the 19th century, Britain moved toward free trade when it was the dominant manufacturing power. The repeal of the Corn Laws wasn't just about economics, it was a statement of confidence. A century later, the U.S., after becoming the world's industrial leader, played a similar role in shaping a liberal global order post-WWI. But before that, during its rise, it used protectionist policies heavily to nurture domestic industries. That pattern is worth noting. Rising powers often use tariffs to build strength, while declining ones resort to them to defend what's left. So when we see a renewed reliance on tariffs today, particularly in U.S. China relations, it's not just about trade deficits. It's a reflection of deeper shifts in global power. The U.S. sees its dominance being challenged, not just economically, but technologically and militarily. China, for its part, is asserting itself as a global actor with its own interests and systems. The tension isn't over a few percentage points of GDP. It's about control over supply chains, influence over institutions, and leadership in critical technologies. Tariffs become part of the broader playbook. By raising costs on imported goods, a country hopes to reduce dependency, protect strategic sectors, and reorient its economy. But beyond the direct effects, tariffs carry signaling value. They show resolve. They draw lines. They test the other side's willingness to concede or retaliate. In that sense, they are diplomatic as much as they are economic. When the U.S. imposed tariffs on Chinese steel, aluminum, and tech goods, it wasn't simply trying to reduce a trade deficit. It was sending a message. The previous model of globalization, where capital and production flowed freely and efficiency ruled over resilience, was no longer acceptable. Strategic autonomy had become the new objective. The same applies to China's response to it. Targeting U.S. agricultural goods wasn't just retaliation. It was aimed at the political base behind those decisions. What complicates this further is the interdependence that globalization created. Both nations are deeply integrated. Decoupling is not clean or easy. Imposing tariffs in such an environment increases friction in the system. It forces companies to rethink supply chains. It accelerates shifts that were already underway toward localization, regional blocks, and technological sovereignty. Over time, these moves reshape the structure of the global economy. When a country that once championed open markets begins using tariffs as a regular part of policy, the signal it sends to the rest of the world is loud and clear. It tells others that the rules have changed. And when rules change, behavior follows. Other nations respond in kind, sometimes with their own tariffs, sometimes with currency adjustments or investment restrictions. The result is fragmentation, less cooperation, more rivalry, more duplication of effort. This fragmentation doesn't always lead to open conflict, but it raises the risk. When nations stop depending on each other, economically, the cost of confrontation goes down. Economic interdependence has historically been a deterrent to war. When that interdependence unravels, buffers weaken. Tariffs are one mechanism through which that unraveling takes place. The shift from cooperative globalization to strategic competition is not inherently bad or good. It depends on how it's managed. There are reasons for nations to pursue self-reliance in certain sectors. And resilience matters, but when economic tools like tariffs are used without a broader strategy or understanding of consequences, they can backfire. Retaliation leads to escalation. Markets react, supply chains fracture, inflation arises, and the initial strategic goal, whether economic independence or geopolitical leverage, becomes harder to reach. To use tariffs wisely, a country needs to see the entire chessboard. That means understanding not just the direct economic impact, but also the second and third order consequences, how other players will respond, how markets will adjust, how institutions will shift. It requires aligning domestic policy, education, infrastructure, R&D with long-term strategic goals. Tariffs, without that alignment, are blunt instruments. With it, they become part of a broader toolkit for navigating a shifting world. The return of tariffs as strategic tools is a sign of the times. The global order is in transition. The roles of major powers are changing, and in periods of transition, nations use every tool at their disposal to shape the outcome. Tariffs are just one of those tools, but they're revealing. They show us not just where the pain points are, but where the future conflicts may emerge. Currencies are not just pieces of paper or digital entries in a ledger. They are representations of economic strength, capital flows, political intent, and trust. When we talk about currency appreciation, especially in the context of the Chinese yuan, we're not just dealing with numbers on an exchange rate screen. We're looking at the outcomes of deeply interwoven forces, trade balances, monetary policy, productivity differentials, and geopolitical strategies. And more importantly, we're looking at a tool that, when properly understood, can be used to rebalance relationships that have grown unsustainable. For years, China ran large trade surpluses with the rest of the world, and especially with the United States. It exported far more than it imported, accumulated reserves, and used those reserves to buy foreign assets, particularly U.S. Treasury securities. This model worked well during China's high growth phase, when the goal was to build capacity, absorb labor, and fuel industrialization. A stable and undervalued yuan supported that model by keeping exports competitive. But as with any system driven by imbalance, over time, the distortions become more costly. A currency that remains undervalued for too long contributes to persistent surpluses on one side and deficits on the other. The country running the surplus builds up reserves and foreign assets, while the deficit country accumulates liabilities and loses competitiveness. In China's case, the undervalued yuan contributed to capital misallocation, incentivizing overproduction, suppressing domestic consumption, and creating dependency on external demand. For the U.S., the counterpart was a hollowing out of the manufacturing base, rising debt levels, and an increasing reliance on monetary policy to sustain growth. Both sides became vulnerable in different ways. One of the most direct ways to correct such imbalances is through currency adjustment. If the yuan appreciates, Chinese exports become more expensive in foreign markets and imports become cheaper domestically. This naturally leads to a reduction in the trade surplus. At the same time, appreciation increases the purchasing power of Chinese consumers, encouraging consumption and rebalancing growth away from investment and exports toward domestic demand. That's the structural shift China has been aiming for. And global perspective, if the yuan were to become stronger and more widely used in international transactions, it would also serve as a stabilizing factor in the global monetary system. Right now, the U.S. dollar occupies an outsized role in global trade and finance. This creates asymmetries. The U.S. effectively supplies the world with liquidity by running deficits, but this also means it is exporting demand and importing deflation. A more appreciated and internationally accepted yuan could provide an alternative, diversifying risk and reducing systemic dependency on a single reserve currency. However, appreciating a currency isn't as simple as flipping a switch. It involves complex trade-offs. For China, a stronger yuan could hurt export competitiveness in the short term, which is politically sensitive in regions reliant on manufacturing. It also exposes financial vulnerabilities, especially if appreciation leads to capital inflows and asset bubbles. Managing the transition requires tight coordination between monetary, fiscal, and regulatory policy. Timing matters. Confidence matters. Sequence matters. There's also the question of intent. A country can let its currency appreciate gradually as part of a broader strategic plan, or it can resist appreciation out of fear of disruption. What history shows is that resisting necessary adjustments only delays the inevitable and usually results in a more disruptive correction later. Letting the exchange rate move in line with fundamentals rather than trying to manipulate it artificially is generally the safer long-term path, even if it requires absorbing short-term pain. In the context of U.S. China relations, currency appreciation is not a concession, it's a logical step in the maturation of China's economy. It helps align China's domestic goals with global expectations. It reduces trade tensions by addressing one of the core drivers of imbalance. And it positions China for a more sustainable, consumption-driven growth model. At the same time, it forces the U.S. to make its own adjustments. As imports become more expensive, domestic production becomes more attractive. This can be catalyst for reindustrialization and investment in real productivity if the right policies are in place. So currency appreciation, particularly of the yuan, isn't just about moving numbers on a chart. It's about restoring equilibrium to a global system that has become unbalanced. It's a reflection of deeper shifts, the rise of new powers, the restructuring of old models, and the search for a more sustainable future. When used wisely, it's not just an adjustment mechanism, it's a strategic tool for stability. To understand the trajectory of great powers, you have to look beneath the surface, beyond the noise of trade tensions, policy headlines, or currency fluctuations, and focus on the fundamentals. The real story is always about the strength and sustainability of a country's internal systems. That means productivity, debt, capital allocation, innovation, education, and governance. These are the roots. And right now, both the United States and China are facing internal challenges that threaten the long-term sustainability of their models. If they want to navigate this period of heightened rivalry and global transition without descending into deeper conflict, they must begin by putting their own houses in order. For the U.S., the primary challenges stem from fiscal indiscipline and structural hollowing in the real economy. Decades of running large fiscal deficits, especially during peacetime and economic expansion, have resulted in a mountain of debt. That might not seem like a pressing issue when interest rates are low and the dollar remains the world reserve currency, but these are privileges that can erode. History has shown again and again that empires begin to decline when the costs of maintaining their positions outpace the returns they derive from them. Excessive borrowing to fund consumption rather than investment in productive assets weakens the economic foundation over time. At the same time, the U.S. allowed its manufacturing base, once the engine of growth and innovation, to atrophy in favor of short-term financial gains. Offshoring, financialization, and underinvestment in physical and human capital created a brittle system. Efficiency was maximized at the cost of resilience. In a world that is becoming more multipolar and less stable, that's a dangerous position to be in. Revitalizing manufacturing isn't about nostalgia. It's about strategic autonomy, innovation, and middle-class strength. It requires long-term thinking, coordination between public and private sectors, and a reallocation of capital toward real productivity growth rather than financial engineering. Reducing the fiscal deficit is another foundational step. That doesn't mean austerity in the traditional sense, which can be counterproductive. It means restructuring how capital is used, cutting wasteful expenditures, increasing the return on public investment, reforming entitlement systems, and ensuring that borrowing is channeled into assets that generate future income. It's not just a math problem. It's a matter of priorities. An empire cannot be sustained if its internal finances deteriorate beyond repair. China, on the other hand, faces a different but equally complex set of internal challenges. Its model, based on high levels of investment, state-driven growth, and export reliance, is reaching diminishing returns. There's only so much infrastructure you can build before the marginal utility starts to decline. The debt that supported this growth, particularly in the local government and shadow banking sectors, has become a structural vulnerability. It's not about whether the debt exists, but whether the returns on that debt exceed its cost. Increasingly, they don't. At the same time, the domestic consumption engine remains underdeveloped. The savings rate is high. Household income as a share of GDP is low, and the social safety net is underbuilt. For China to transition into a more balanced and sustainable model, it needs to shift demand inward. That means empowering households, reforming the hukou system to enable labor mobility, expanding healthcare and pension coverage, and allowing market forces a greater role in allocating resources. The debt problem must be tackled not with sudden deleveraging, which would risk a sharp slowdown, but with a gradual restructuring. That includes cleaning up bad debts, recapitalizing financial institutions where necessary, and tightening regulation on speculative lending. Simultaneously, capital should be redirected from low-return, politically driven projects toward innovation, services, and high-value manufacturing. The shift will be painful, but the longer it's delayed, the harder it will become. Both nations are at inflection points. External competition has a way of exposing internal weaknesses. And while rivalry can be a motivator for reform, it can also be a distraction. The temptation is always to blame the other side. But the real progress comes when countries look inward and strengthen themselves at the root. There's a saying, strong trees don't fear the wind. In a more volatile and multipolar world, resilience will be the key differentiator. The U.S. needs to get its fiscal house in order and reinvest in its productive base. China needs to empower its consumers and deal with its debt overhang. Neither of these tasks is easy, but they are necessary because in the long run, power and stability come not from the tactics of trade negotiation or monetary tweaks, but from the health of a country's internal systems. That's where the real competition is, and that's where the outcomes will ultimately be decided. When looking at the course of history, especially during moments of transition between world orders, the difference between peaceful evolution and destructive conflict often lies in how well rival powers manage their relationship. In these moments, when a rising power challenges an existing one, tension is inevitable. But how that tension is handled, whether through competition alone or through thoughtful cooperation, determines the nature of the next era. Today, with the U.S. and China occupying the central positions in a shifting global landscape, what's most needed isn't zero-sum thinking or reactive policies, but a cooperative approach grounded in mutual understanding, strategic negotiation, and historical awareness. The natural tendency in such times is for mistrust to escalate. Each side interprets the other's actions through a lens of suspicion. Defensive moves are seen as aggressive. Efforts to secure economic or military advantage are perceived as existential threats. It becomes a self-reinforcing cycle. But this pattern isn't new. We've seen it play out throughout history in the rivalry between Athens and Sparta, between Britain and Germany, or more recently in the Cold War dynamic between the U.S. and the Soviet Union. In almost every case, the lack of empathetic perspective and strategic dialogue exacerbated the conflict. So the challenge now is to break that cycle. And that begins with understanding not just of intentions, but of systems, motivations, and constraints. The U.S. and China have fundamentally different historical experiences, governance models, and societal priorities. These differences aren't going away, but they don't have to lead to confrontation either. In fact, they can become the basis for complementary coexistence if approached intelligently. To do that, both sides must be willing to see beyond the immediate point of friction and recognize the broader picture. We are entering a world that requires coordination, not fragmentation. Cooperation doesn't mean abandoning interests. It means aligning long-term objectives where possible, managing inevitable conflicts of interest in ways that don't escalate, and creating mechanisms to handle disputes rationally. It requires stepping back from ideology and ego and thinking systemically. What kind of global system do we want to operate in 10 or 20 years from now? What roles will each power play in maintaining that system? What risks are we willing to tolerate, and which ones must be mitigated through structured engagement? Strategic negotiation plays a key role here. The most effective deals are not those that extract the most from the other side, but those that create ongoing value, a framework for stability and progress. This kind of negotiation demands clarity, trust, and patience. It also requires both sides to take some political risks, to make moves that might be unpopular in the short term, but necessary for long-term stability. That's difficult in any political system, but it becomes essential when the cost of miscalculation is so high. There are areas where interests overlap more than they diverge: climate change, financial stability, public health, supply chain security. These are global issues that no single nation can solve alone. They demand joint efforts. When trust is low, starting with pragmatic cooperation in such areas helps to build the foundation for broader alignment. It creates momentum. It demonstrates that progress is possible, even amid disagreement elsewhere. But cooperation also requires strength. Weak nations don't cooperate, they comply. For cooperation to be meaningful, it must be between strong actors who respect each other's capabilities and limits. That's why internal reforms in both the U.S. and China are critical, because they provide the confidence and clarity needed for strategic engagement. A nation that is secure in its foundation has the flexibility to be pragmatic. Mutual respect does not come from words alone. It comes from understanding the other side's red lines and communicating your own clearly. It comes from being transparent about objectives while remaining flexible on tactics. And it comes from having the discipline to distinguish between issues of principle and matters of positioning. In an increasingly multipolar world, the cost of fragmentation is high. Global capital flows, technological ecosystems, and geopolitical fault lines are deeply interconnected. A breakdown in U.S. China relations would ripple far beyond the two nations, disrupting markets, undermining institutions, and increasing the risk of outright conflict. That's not a future anyone should want. The goal, therefore, must be to manage rivalry without losing control of the relationship. That requires more than summits and communiques. It demands a shift in mindset from confrontation to coordination, from short-term wins to long-term frameworks, from reaction to reflection. If history teaches one clear lesson, it's that great powers that navigate transitions peacefully tend to remain influential longer. Those that pursue dominance without understanding the full game board often burn out more quickly. In this moment, the world doesn't need another ideological contest. It needs a model of mature statecraft. That starts with cooperation, and cooperation starts with the will to understand. The U.S.-China relationship is at a pivotal juncture. By understanding the deeper economic and geopolitical forces at play, both nations can chart a course towards mutual prosperity and global stability. Thank you for joining this discussion. Let's continue to explore these critical topics together.